Welcome everybody to our Wednesday morning series um, of real estate education for real estate professionals and enthusiasts, let's say. Great to have you all here. Today, the topic is passive real estate investing, private equity. I'm doing this session today with Gerry Hogenhout. Gerry Hogenhout's a CPA, and he has many other designations as well. Gerry and I have been running events together for quite a while. We talk about mortgages, we talk about taxes, we talk about real estate investing, and one subject that's very near and dear to everybody's heart, I think, is the topic of investing. And I think a lot of people are very interested in real estate investing for obvious reasons. Well, I mean, one of the reasons is something you can see and touch, whereas if your money's in the stock market, it goes up and down, sometimes wildly. We don't always understand why. And I'm a licensed dealing representative. And what that is a person who's able to sell private equity. And we're going to talk about what private equity is, and we're going to talk about real estate investing. We're going to do an update on the PRECs, personal real estate corporations for real estate agents. It's not only real estate agents on this call, but Gerry has been doing a lot of work with real estate agents, and we're going to do an update and talk a bit about that. So Gerry, if we could start, you want to tell us a bit about your passion for real estate investing, and then also, what is private equity?
Hey, thanks, David. Welcome, everyone. Yeah, my passion for real estate investing, where the heck did that start? Started quite early, actually. Way back in the day, being 22, buying my first house for $50,000, which was an enormous amount of money back then. So it was pretty freaky to go to the bank and get a $45,000 mortgage. But so it started way back then, continued, and it's kind of interesting because I myself branched into the investment. I'm a public accountant, worked with Deloitte Touche for many years. Then set up my own practice, but also expanded into the investment world. And I got into everything, every type of investment you could do: real estate, stocks, mutual funds, private equity, everything. And then I just kept going back to real estate. I kept buying another house and another house and another house. And the real estate part of the portfolio worked out really well. And then what I call the public asset market, stocks and mutual funds, I mean, they were just going up and down like crazy, out of control, more or less, without real rhyme or reason. As you said, David, some of this stuff we just don't understand why it goes up and down. And so I just found that real estate was a much more it was certainly, the fundamentals are much easier to understand. We all, probably most of us, have owned property. If we own rental properties, it's a pretty simple concept. We have a property, we collect the rent, we pay some expenses, we have net rent. And so it's a very easy concept to understand when you compare it to hedge funds and everything that goes on in the publicly traded market, which been around for 40 years, and there's some of these hedge fund concepts I don't even get. So some of this stuff on the public asset side is very daunting. Hey, listen, I'm the first to say you can make a lot of money in the stock market. You can make a ton of money in the stock market. You can lose a lot of money in the stock market, which means there's a lot of risk in the stock market. And if that's your game, then that's a good place to be. I always try to put the protection of capital ahead of the rate of return. And I've yet to find anything better than the right type of real estate. There's good real estate, there's bad real estate, but the right type of real estate, in my opinion, gives you very, very good protection of your capital, and can get you a decent rate of return. I mean, I think most of us that invest in real estate, we're not looking to shoot out the lights. We're trying to get 10%, 10 to 15% pretty consistently without the ups and downs, and we want good protection of our capital. So certainly that's led me to look at real estate as, really focus in that area. And that's certainly what we do at Canadian Investments. So,
Gerry, talk to us, please, about private equity. What is private equity? I mean, what is that? Why is it called private equity?
Private equities, because in my the way I view things, and the way the market is structured, we have public markets and private markets. And companies go to the public markets in order to become a publicly traded company, in order to access capital from the various stock markets that have been created all around the world. So the stock market certainly is an avenue to access capital. It's an avenue where you can use stock options to incentivize investors, management. So to think of it a different way, there's a whole market. The public market has a market created for it on its own to buy and sell shares and to raise capital. Then when you talk about private equity, that market isn't there. Okay, so private equity is just literally private companies that either have chosen not to go down the public route. They don't want to access. There's a big cost involved with going public. The whole IPO structure to go public. There's a lot of costs there, a lot of compliance. Lots of companies don't need to do that. Lots of companies don't want to do that. But these companies, which are private companies, just companies around the corner, they're private companies, but they want to raise capital. And that is really what private equity is. It's a company that's privately owned, not publicly owned. It has a desire to raise capital, and it does so through the rules and regulations governing the private equity marketplace. So when that happens, they have to go through what we call an exempt market dealer. Oh, who's that? So they have to go through the exempt market dealer, or the exempt marketplace. So how that works is, if they want to raise capital, they go to an exempt market dealer, and then that private company becomes what we call an issuer. So it sits on the shelf of an exempt market dealer. And then that exempt market dealer licenses representatives to help raise capital for that company.
Are these higher risk, Gerry, than investing in the stock market?
Well, again, private equity is a very wide umbrella. So you can have oil and gas private equity. You can have angel investor private equity. So yeah, there's lots of risk in those types. But in my opinion, private equity affords us also to invest in a lot of what I call low risk. Again, there's good real estate. There's good real estate and bad real estate. So in the private equity world, we can really source a lot of what I think is good real estate investment opportunities. So, in my opinion, we minimize and diminish our risk, and we can get a decent rate of return. I target, when I bring my clients into the real estate private equity world, we target a 10 to 15%. And a lot of the companies we use get that consistently. That's the key. It's funny, in the financial planning world, we use all these formulas, and some of you may know what the rule of 72 is, which are, if you know it, you know it. If you don't, it's two numbers multiplied together to equal 72. So for example, 6 times 12 equals 72, which means if your money makes 6%, it will double in 12 years. Okay, so we use this rule of 72 in a lot of cases, but when we use that type of thought process in the stock market, it never works, because the money's going up one year, down the next year, up and up and up and up. The only time this rule of 72 concept works is if we have consistent returns. Okay, if we can make 10% every year, 10 times 7.2 equals 72. So if we make 10% consistently, then our money doubles in 7.2 years. So consistency is something that people like too. Instead of making 30% one year and losing 15% the next year, and then making 25% next year and losing 40% next year, people would much rather just earn 10% year after year after year after year. And that's what good real estate private equity funds, that's one example. Mortgage income mix will get you that. So a lot of investors looking for consistency.
Okay, so Gerry, I just want to elaborate on this just for a moment. So to your point, I think one of the key differences between private equity and the public markets is that the unit prices that you pay, they're not going to swing up and down like the stock market.
Right.
So that's to your point about, you know, making 20%, losing 40, because if you have a stock portfolio, that's what happens. So you avoid that
Yeah.
with private equity, but it's not as liquid, is it?
No, it's not as liquid, and I'm glad you brought up that point because before I answer the liquidity question, in the public market, when we go into stocks or mutual funds, everything that goes on around the world affects the value of our stock. These stocks are valued every day based on the performance of the stock markets around the world and what goes on around the world. So if we're in the stock market, there are things way beyond our control that affect the value of our price. And that's, we have no control of that stuff. And that's one of the reasons why I've never really fancied throwing money into the stock market unless I really want to try to make 30% and gamble my money. In real estate investment trusts, what happens around the world is irrelevant to the value of our investment. What is relevant to the value of our investment is the bricks and mortars that we're investing in and the fundamentals within that concept. For example, apartment buildings, which a real estate income trust, it really holds apartment buildings, and those apartment buildings are valued on cap rate, you know, which is really a valuation formula based on the rents that are received. So if we're comfortable that the rents received will remain consistent, then we're very comfortable that our asset backing our investment will remain in place, and irregardless of what happens around the world. So it's certainly, it's a safety net. Now, as far as liquidity, yes, if you go in the stock market, your money is liquid depending on how the investment is structured.
On investing in real estate.
Please mute yourself, somebody.
Somebody's talking.
Listening to a webinar.
I wish I could see who it was.
Do you have the culprit? Do you have the culprit?
Guys, also just want to mention, feel free to type in questions. You're all unmuted, so if we could ask questions even verbally in an orderly fashion, that's fine.
Well, as far as liquidity, yes, if you're invested in the stock market, depending on how it's structured, most of the time that's very liquid. You can get in and out. We have what's called trade 3, T3 we're called, it's called, but it's very liquid. You can get your money in and out as needed. When we went to the private equity world, we really view that more as a longer term investment. And it's not as liquid. That's very important for people to realize. Don't go into a real estate private equity fund with the intention of getting out in 3 months. I mean, it's really a 2 to 3 and beyond, 2 or 3 year and beyond commitment. So how most of these private equity companies work is you can get your money out. They usually have redemption periods, and very common to have 4 of them during the year. So you put your money in now, what are we at, March 17th. They would have redemptions on March 31st, June 30th, September 30th, and December 31st. So they would have times throughout the year where they open up to redemptions. Now remember, when you invest in a private equity fund, there's no what we call secondary market. Okay, what I mean by that is back to the stock market. They have a secondary market. When you want to sell your stock, you go to the marketplace and sell it to a willing buyer. That's what happens millions of times a day. Okay, so we call that a secondary market if you're in the stock market, if you're in public assets. So if you want to sell, you go to the market. Who wants to buy my share? That determines your price. In the private equity world, there is no secondary market. So when you want your money back, you're not selling your share or unit to a third party. You're giving it back to the company, and the company is giving you back your money. We call that a redemption. Okay, so it's very important to realize that there is no secondary market. So the company that we invest in dictates the terms of our redemptions. And again, it's very common for these companies to say, okay, March 31st, Anybody want their money back? June 30th, September 30th, and December 31st. Also, they can put limits on what they redeem. Okay, just like a bank. If everybody went to the bank and said, I want to pull my money out, the bank sooner or later says, stop. Stop, everybody's accounts are frozen. We got to sort this out. We don't have the money to give everybody back. Okay, the private equity world is the same. If half of the people, think of it this way, if a company had 10 real estate buildings in their fund and half of the people wanted their money back, that's not fair to the other half that still want to remain invested. So they put limits on what they redeem each March, each June, each. So for example, you could invest today and you could say, geez, I need my money back. March 31st could be full. So we'd put you on the June list. And if June's full, we'd have to put you on September list. So we certainly have to be aware of the liquidity issues. Okay, private equity companies can also stop redemptions. If we don't see it very often, I've only seen it once, but they can go, hey, we have 10 buildings and we see building 11 and 12 that we're going to buy. So we're going to stop redemptions and we're going to buy those buildings. So liquidity is different in private equity. But, you know, been in this private equity game for 15 years. I've never seen where a company has not accommodated an investor when they need their money back. So, you know, it's something to be aware of, but in reality, you know, it's as liquid really as you need it to be. The whole key is to not, you know, when you go into an investment like that, really you've got to consider it as more of a longer term investment. The longer you're in there, the more apt you're going to get a consistent 10 to 15% rate of return.
Gerry, tell us please about Canadian Investment Services, your company.
Yeah, so
why
thank
did you start it? What's it about?
Well, it started, you know, I don't want to put a negative slant on things, but I started because I'm somebody that's very critical of how investment advice is dispersed in Canada. And I'm critical about it. I'm an advocate to better educate people how they get their investment advice. 99% of investment advice comes from someone holding an investment license, which sounds okay, but in my opinion, it's not, because with an investment license, the fiduciary responsibility changes. If you hold an investment license, you cannot put the best interest of a client first. And that's a very sad comment. And it's true. Okay. If you hold an investment license, your fiduciary responsibility goes to the company that licenses you. It does not go to the client. So all of a sudden, if I held a license, and I've held them all, you can't do what's best for the client. You have a company that licenses you. They dictate you to sell what you're told to sell. And over the years, I came to realize that that's just the wrong way to provide investment advice. So I created Canadian Investment Service to basically provide a proper channel for investment advice. We do not hold active investment license. We don't want investment license. And that allows us to do a couple of things. One, it allows us to access everything on the marketplace. Okay, so for example, we talk about private equity. For those clients that want to participate in private equity investments, I need a licensed rep. I need a dealing rep that's licensed through an exempt market dealer. And there's my good friend, David Grossman, who just so happens is a licensed dealing rep with an exempt market dealer. So that's one way that I would utilize or access private equity investments. By me not holding an investment license, it also allows me to do my own real estate investing. Okay, we do a lot of real estate fix and flips. We bring our clients together. We do a fix and flip. We buy a house. We've done 4 flips in the last 18 months in Toronto. Buy a house, knock it down, and rebuild it, and put a group of people together. And you know, that's a real estate investment opportunity. We do a lot of real estate limited partnerships, joint ventures, private mortgage lending. We do a lot of mortgage lending in RSP. So by not having an investment license, I can do a lot more for the client and make sure that the advice we give is very unbiased, and we can actually, it's the only way we can put the best interest of the client first. So it's very different. It's unique. I'm the only company that I'm aware of that provides investment advice and service that way, but I think it's the best way.
Gerry, can you talk to us about mortgage investing? People always, you know, seem to like investing in mortgages. Do you get a lot of requests for mortgages? What's the allure, do you think, for mortgage
I
investing?
think the allure, I mean, mortgages along with real estate, I think people, again, I go back to my earlier comment about, I kind of look at there's the public market and the private market. And again, I go back to what I said, 99% of your advice is given to you by someone with an investment license. If you go to a bank, where do you think you're going to end up? Mutual funds. Okay. When you go to most licensed, when you go to a Money Concepts, when you go to Investors Group, when you go to an Edward Jones, where are you going to end up? In the public market. You're going to be in stocks or mutual funds, whether you want to be or not. People are starting to realize and figure this stuff out. And they're going, why am I in the market? Why haven't, probably the comment I've heard the most over the years is, well, my money's sitting in mutual funds or stocks and I haven't made any money. So the allure is finally people start to get a little more educated. Everybody likes real estate. Real estate is easy to understand. The fundamentals are easy to grasp. So they go over into real estate. And one of the reasons we've seen the boom for all this real estate, immigration has fueled most of it, but there's also a ton of money leaving the stock markets and going into real estate to find a proper investment home for their money. And when they go into the real estate market, when you think of a house, any house, you look across the street and look at a house, that house you can own or lend against. So if you want a real estate related investment, you can get a building and buy it, or you can lend against it. You can buy it individually. You go buy a rental property. You can buy it as a group, which is a real estate income trust. You can lend against it individually, which is just private mortgage lending, or you can lend against it as a group, which is syndicated mortgages. So there's your 4 things you can do. So as people gravitate from the public market, real estate has become very interesting. Why? I think the allure of mortgage lending, because if it's done right, it can be done wrong, it can be done right. But for those people that are have experienced mortgage lending in their own portfolios, and if it's all been done right, they've just been getting a nice check every month. There's no hiccups, again, if it's structured properly. Not saying things can't go wrong, but there's ways to mitigate any risk that's involved. So most of these people have had very good experiences, earning 10 to 15% as second mortgages, good second mortgages. Lots of reasons why people will pay the higher interest rate.
Gerry,
yep.
Yeah. You talked a lot about private equity and you talked about public markets. So would you ever advocate that somebody cashes all their money out of the public markets and put it all into private equity?
Well, it's not, I don't really
suggesting?
advocate anything. Okay. My whole role is to first educate people, give them the information so they're properly informed and understand more than they do. So with that education, I always like to let the person make the decision. I don't want to make the decision for people. Sometimes I'm put in a spot where they want me to, which is okay, but I'd rather take the time first to teach you, educate you, explain what's going on, explain, I hate to say it this way, but explain how you've been probably ripped off over your whole life, having your money invested in different ways. It has not been in your best interest.
No
So I
kidding.
try to explain all that. And then the person leads, oh, yes, I like real estate. Well, do you want to own? Do you want to lend? Explain all that to them. So they usually lead me to where they want to go. And most of the time we're into the real estate world. Everybody likes real estate. So we're playing around in that real estate game, either as ownership, individually, as a group, real estate income trust, borrowing money. The amount of times I've explained to somebody that, hey, do you know you can hold a mortgage in your RSP? And they look at me and they go, you're kidding. And I said, no, you can. And they didn't know this stuff. And they haven't been properly informed. So to put some proper information into people's financial lives is a very rewarding thing, not only for me, but for the person themselves, because all of a sudden they feel a little more in control and they can make some decisions. So it's helpful in the process when people
Gerry,
get a better understanding.
didn't they also do studies where they took like a monkey and to throw a dart at a dartboard to see what stocks to pick, and they found that they did just as well
Well,
as
I'll
what
tell you,
as the other mutual funds that were being
I remember
professionally managed?
I left. I was at Deloitte Touche for 10 years, set up my own practice in 1990. I've got a very strong tax background, public accounting background, very regulated, very structured. Set up my own tax practice and then ventured in the financial services world in 1995. And I go into that world with a strong professional and ethics background. And then I go into the investment world and like unbelievable what I saw. Okay, people, last weekend there's a car mechanic, and this weekend they're a financial planner. So the ethics. So I went into that industry really wanting to learn, had access to many great people, and I had the benefit of having access to mutual fund managers, my God, and stockbrokers. And these people were talking circles around me. So highly educated people. I'm trying to learn the industry, and I'm like, wow, okay, I've got a lot to learn in this industry. You guys are at a different level. So I learned everything I needed to learn, got to those levels, and realized very quickly, none of these people with all their degrees in education and everything else, and I say the same thing today, nobody out there can predict where the market is going with enough accuracy and efficiency to really formulate a good investment portfolio. Okay, they're talking great. They have you believing that whatever they're selling will go to the moon. It won't. I've never met anybody yet in 40 years, and I've dealt with lots of highly trained, skilled brokers, equity, hedge fund people, and nobody can get it right on enough consistency to create a good portfolio. And that's when you say, what is the allure of real estate or mortgage investing? Well, because that all that stuff I just mentioned happens in the publicly traded market. Now you go to the private equity market and you're going, oh, there's a apartment building that collects rent. That's pretty easy to understand. They collect the rent, they pay the expenses, and there's net rent. Hey, what are you guys doing with the net rent? Well, we distribute it back to the investors. Pretty simple to understand, and it works. So, again, I don't want to be critical, but I've yet to find anybody who can consistently beat the market consistently enough for me anyway to be comfortable to say, hey, client, this is a great way that we can make 10% every year. Let's invest in the stock market. I've yet to find it. So
yeah, there's a number of questions we have, and we'll try and cover what we can, but I'm just going to pick one or two for now.
Yeah.
One is Joseph. He says real estate in most cases falls in most cases under capital gains as opposed to income. How are all these different private funds seen by Revenue Canada?
Okay, very good question. Thank you, Joseph. So whenever we look at real estate as an investment, as the thing to protect our investment, I look at investment with two components. Okay, when someone says, Gerry, manage my money, I have two responsibilities. One is to protect capital. The other is to earn income. Okay, and I try to put the protection of capital first. Let's protect the capital first, and then we'll go after the income. So when we do that, when we look at real estate, we need to ask ourselves, are we investing for cash flow or are we investing for capital gains? And the answer is both. Well, we want to invest in a property, we want to get the net rent, and we want that property to go up. Okay, so in most cases that happens. Okay, and both of these types of income are treated differently. So a capital gain is basically an increase in the value of your investment. So if you buy a house for $100,000, keep it simple, and if that house goes up to $150,000, your asset has gone up. So it's gone up from 100 to 150. The difference is 50. We call that a capital gain, and that has preferential tax treatment. Okay, so that's one part of the equation. The other part of the equation is the house we bought for $100,000. If it was a rental, we're collecting rent income. And that rent income is 100% taxable. We call it passive income. And that has a whole bunch of tax implications to it, both good and bad, things we can structure around. But usually real estate creates two types of income: capital gains, which is the appreciation on the growth of the asset, and income, which is what the asset is doing. It's renting out a building and we're collecting that income. So both of those are treated differently for tax purposes, and both of those concepts are different for investors. When we do fix and flip projects, okay, we are 100% focusing on a capital gain. We are not focused. There is no component of cash flow. Okay, we're buying a house, we're knocking it down, we're rebuilding it, reselling it. We've never had a tenant in that project, so there is no net rent income. That type of project is strictly 100% growth oriented, capital gain oriented. Then there's the issue of, is it a capital gain or is it business income? Okay, CRA, looks at me and has done 4 flips in 2 years. That's going to be normal business income. It's not taking an asset and it goes up in value and we get a capital gain. In my position, it would be that's the business activity of the business. They will tax that as normal business income. So I guess as simple as your question was, like most things, it doesn't have a simple answer. So really the gist of it is we're using real estate as the thing to protect our money, but we're also using real estate to dictate what we want to get. Are we after income? Are we after capital gains? Are we after capital growth? Are we after both? Most people are both. For example, in the real estate income trust world, for example, David, as you know, there's 2 companies that we, very familiar with and utilize. There's Centurion REIT is one of them, and there's Poulos REIT. Centurion is more what I call income driven. Okay, you're going to put your money in there. For 45 years, they've been averaging 8 to 10% consistently, no ups, no downs, just consistently. So we look at a company like that more from an income purpose. If someone wants cash flow. Then when you look at kind of a Poulos, we look at it more, it's a combination of the both. So if we want a little more growth, Poulos is a company that buys more apartment buildings that need work. Okay, so they'll take all the rent, pay their expenses. Now they have net rent. What are they going to do with that net rent? I'll keep the concept simple. They'll give half of that net rent back to the investors as a cash flow. They'll keep the other half and put it back in the building. Okay, if you're going to put money back in the building, in theory, the building goes up in value. And that's what happens. So with a Poulos model, we get growth and income. In a Centurion model, we more focus on income. Other models, we could focus more on growth, like my fix and flips. That's focused 100% on growth. So again, when we use real estate to protect the asset, we also have to dig a little deeper and go, are we in here for income? Are we in here for growth? Or are we in the middle? Are we looking for a little bit of income and a little bit of growth? So,
Gerry, Deborah asked, if you go into a flip with you, what is the minimum amount you have to invest?
Yeah, we usually start at $100,000, so it's not something we're putting $5,000 or $10,000 in. So it's usually 100. We would entertain smaller investors, not so much that we need to. I just want to be sympathetic. Some people, not everybody has $100,000 to write a check. So, if somebody is really looking to get into a project, we can put in smaller amounts of money. But the amount of money you have invested really dictates the involvement you have in the project. If I need $1 million, and if I have one person putting up $600,000 and a whole bunch of people putting up $50,000, your voice is not quite as loud as the person with $600,000. Your returns will be the same based on the amount of money that you have put into there, but certainly at $100,000, you have a voice and you participate in the decision making. I like to get investors involved. Some investors like to be involved. Hey, this is the project. I mean, when we do our fix and flip, most of our investors show up at the job site. They talk to my contractor. They get involved in the project. They walk around. They look and they go, boy, that's nice. So they see their money at work. So, yeah, so, as far as a minimum, there's nothing cast in stone, but, I don't want to raise $1 million and have however many people putting $5,000 in each. I mean, the logistics of that
Okay,
is too
Gerry.
much.
So Deborah's also asking about returns on the flips, and then we've got some questions regarding private equity. Is there a minimum to
Yeah,
invest? How
okay,
consistent have
so
the returns
returns on
been
the
for
private
private
equity.
equity
Okay,
side?
so I'm always very cautious. Okay, I'm not trying to make promises I cannot keep. So when we do these fix and flips, I'm not sitting there going, "Hey, client, come get involved in my fix and flip and make 20%." I don't do that, okay, because that would be chasing returns. I don't want to chase returns. I want to protect capital. So I would say to the client, "Hey, if we've got a fix and flip project, here's what our purchase price is. Here's what we think we can sell it for. Here's what we think we need to spend to build it." So there's a lot of risk involved, and I make sure the client is well aware of that. We have, things can go wrong. Things did go wrong. COVID happened. My God. So, I got stuck with 2 projects when COVID hit. Now, what's the impact of that? Well, we didn't get shut down, but getting material was a logistics problem. Having people working on site was a logistics problem. Most of these projects have, let's just keep it simple, half of it is borrowed money, half of it is equity money. The borrowed money, they want an interest payment every month. So my projects, instead of being 6 months, turned out to be 10 months because of COVID. So I paid a lot of interest, so that wasn't, people have to realize that things happen on a job site. We got robbed on a job site. Next thing, we go to the job site one morning and all our kitchen, the toilet was 5 bathrooms, they're all gone. Everything, like, we got robbed. And, so things happen on these job sites. So there's risk. And it's really for somebody with an appetite. We try to get in and out real quick. 9 months, we try to say, and I always say extend that to a year. So if you're getting involved in one of my flips, we need your money for a year, and maybe longer if we have a problem selling it. Okay, the market is hot in Toronto, but we've had some experiences where we're done. We do what everybody else does. We put the property up for sale. Bring your offers next Monday night, and let's look at them all. And we've had good experiences with that, and we've had nights where there's no offers.
Gerry,
So,
can you tell me, please, about this financial planning tool that you have that you've been giving away for free that some
yeah.
financial planners are charging like literally thousands of dollars?
Yeah. So I guess, again, back to my criticism about the investment market, I'm very sympathetic of how people get investment advice. And I've told you that. There's a much better way, and that's the way we provide it. And then I took it to the next stage of these financial planning softwares. Okay, so if you're going to go to a licensed financial advisor, and if you're going to go to them and say, do a financial plan for me, guess what? You're going to have, they're doing your financial plan, and you're going to have whatever product they're selling inside of your financial plan. Okay, so I'm someone who also says the whole financial planning process is backwards. Okay, because again, if you go to a licensed advisor, they're going to start with your product. And I'm going to pick on Investors Group, not because, it's just an easy company to pick on. If you walk through their door, they're selling you Investor Group mutual funds. They're going to start with the product. They're going to do a financial plan behind the product, and they're going to use their product in your financial plan. I think that's backwards. You should start with the financial plan, do your financial plan, then figure out what investment products you want to put into your financial plan. So to me, that's a much better way. Now, how does somebody go get a financial plan? 99% of financial plans are offered by somebody with an investment license. So that doesn't work. 1% of financial plans are available to people of what we call fee-only financial planners. So they don't sell anything, but for $3,000 or $4,000 or $5,000, they'll do a financial plan for you. And that's okay, other than that's pretty expensive. And it's also a one-off. Here's your financial plan. This is what you should do. Thanks for your check. See you later. Bye. And now you got a document that's supposed to help you with the rest of your life. Okay, so I think that doesn't work very well. So what I always thought, and what I do myself, so I just created a 6-page Excel spreadsheet and turned it into a financial planning software tool, taking accounting principles. I'm an accountant, so in our life we deal with financial statements. Financial statements have a balance sheet, assets and liabilities. Financial statements have income statement, revenue and expenses. So I take that concept, and that applies to all of us. Every one of us has a financial statement. We have assets, liabilities, income, expenses. So we take that concept, I plug it into a 6-page Excel spreadsheet, and it becomes an ongoing financial planning tool. Okay, I'm somebody who encourages people, you can do it yourself. Okay, you can do your own financial planning. You need a tool. I offer you the tool for free. And then you need some guidance. You need to figure out how to use this tool. And we do that for you. Okay, we're having a seminar tomorrow night. Is today Wednesday? Yeah, today's Wednesday. So tomorrow night, we're having another one of our sessions to teach people how to use these financial planning tools. And they're free. They're all free. And all you need to
How
do
do
is
people get on that if they want to get on that session?
So they can go to my website, Canadian Investment Services. If you go to that website, you'll get some pop-up menus, and you literally put in your email address. The software will be downloaded to your inbox. We have that email address, and we'll send out invites to when we do these training sessions. We do them each month, but you have the software, you can play around with it. And again, when we do these sessions, we help you learn it. The goal is for you to be able to use this tool to do your own financial planning. And once you figure that out, then again, if you buy into what I'm saying, you do your own financial planning with help. We're there to help. Okay, we're not saying you're going to be financial planners immediately, but if you start plugging in some numbers and seeing how it all works, it's not rocket science. It's a 6-page Excel spreadsheet. You don't have to be an Excel expert. It's very simple to apply, easy to understand. And sooner or later, you start to figure it out, and you can do your own financial planning. And we're there to support when you need a little more enhanced. So it's a great tool. It projects. The thing I like the best, I've used all these financial planning tools, and I never really found anything that really suited my needs. And one of the more important things I wanted to see, I just want to see my financial life on one computer screen from however old I am now till age, and I can set it at any age. Show me my financial life to age 80, show it to 90, show it to 100. And there it is. And then I can put different, interest rates, rate of returns. I can do different strategies. I'm an accountant. I think one of the most important, income taxes are the biggest expense of your life. Okay, most financial planners do not have a strong tax background. So when we do these financial strategies, we really focus on saving tax. And it's amazing how much, if we can save some tax, how much that impacts your whole financial life. And it's even better when you can see it on a computer screen. So it's a pretty interesting little tool. It's free. Go get it.
Is Stephen Clark still here, or Stephen, did you leave? He sent me a note that he had to leave. I was going to ask him to introduce himself. We'll have him, pardon me, we'll have him on a future session. He's from Equity Line Mick.
We'll do
a spotlight on Mix in another session in mortgage investing.
Do you want me to maybe Mix? Should we touch on that, or?
Sure.
So Mix are Mortgage Investment Corp. So back to what I said. You look at a house, you can buy it yourself, you can buy it as a group, which is a real estate income trust. You can lend against it yourself, you can lend it as a group. Mix, Mortgage Investment Corps, are companies that pool everybody's money together and lend out in mortgages. And that's a very good way to diversify, to have your money registered against various houses. The thing with a MIC is they'll have 100 mortgages in there, 200 mortgages in there, 300 mortgages in there, registered on 100 houses, 200 houses, 300 houses. It could be commercial mortgages, it could be residential mortgages. But the fact is your money is protected by real estate, and it's all lent out as mortgages. And these MICs are getting decent, they're making 6, 7, 8% rates of return consistently. That's the key thing, not up, down, up 1 year, down another year, nice consistent return. So MIC is a great investment option. Just understand that when you do mortgage lending, whether it's on your own, either your own money, lending mortgage in an RSP, lending mortgage as a MIC, there's no participation in the growth of anything. Okay, so that's kind of a big difference between, should I invest in a mix? Should I invest in a REIT? Okay, a real estate income trust. With the real estate income trust, you are participating in the growth of the building. Okay, in a MIC, mortgage investment corp, you are not. Okay, it's simply a mortgage lend. It's like you lending your money yourself. It's just that, hey, you don't want to do that, let's say, so you go to a company that's their job. They lend out money within that MIC. There's rules and regulations the government established between what they can invest in, how much money can be in one unit. So, it's a MIC is a great thing if you're looking for.
Gerry,
Yeah.
Gerry, talk to us, please. There was a question, how do you get paid? And then also I got to ask you for an update on the Personal Real Estate Corporation. We haven't talked about that.
Yeah, the pracs. Oh my God, there's all kinds of going. Okay, how do we get paid? Well, we get paid. So my business is two things. It does taxes and investments. So on the tax side, I'm a public accountant, so we do lots of corporate tax returns, trust returns, personal tax returns. So that's how we get paid there. On the investment side, we get paid really one of two ways, three really, but two. If we go into the marketplace where we need a license, okay, there's 5 licenses out there that we can go into. We can go into the MFDA market, that's the mutual fund market. We can go into the IROC market, which is the stocks and bonds. We can go into the exempt market, which is the private equity. We can go into mortgages, insurance. When we go into those marketplaces, I need a licensed person to process those orders. Though that marketplace is either commission driven. Okay, most private equity deals are commission driven, or they're what we call AUM, assets under management. So keep it simple. Somebody has $500,000 and they come to me and they go, here, manage my money. And let's say they're interested in going into a real estate income trust. The $100,000, we would go into a real estate income trust and they would pay us. So the company where we go to pays a commission. The commission has to go to the licensed rep. Okay, and those commissions go anywhere from 5 to 10%, depending on what company it is, different things, how long your hold period is. The great thing is when I work with a client, my service to my client is free. Okay, because I'm going to go, if the client wants a real estate income trust, I'm going to go use a licensed rep. David's a licensed rep. I'm going to give him my client on a silver platter. David, can you look after this client? And David's going to get a commission and we enter into a referral arrangement. So it's the same commission the client would pay anyway, even if they bypass me. So the client, so using my service is free. And the commission does not come from the client's investment. If a client invests $100,000, they invest $100,000. The commission is paid out of the fund by the company. So yes, the 100 grand goes into the fund and the commission comes out of the fund, but the client is still getting credit for the full $100,000 investment. Okay, so that's more of a commission. Now back to the example I mentioned, say the client had $500,000. We move 100,000 into private equity. There's a commission there. It's all explained to the client. The other 400,000, let's say, is sitting in Investors Group mutual funds. Okay, and I would say, okay, maybe we'll leave it in mutual funds, but let's get it out of Investors Group. Let's get it out of the bank. Let's get it out of, Fidelity, McKenzie. Let's get it out of there because they're charging you 2.5% to 3% management fee. You don't even see it. Okay, it just comes out of that fund. Again, it's your money, but they're taking it out. So with that money, we move it over to a robo-advisor. Okay, we call that AUM, assets under management. So that money gets moved over to a robo-advisor. There's no commissions. Okay, but they pay us a service fee as long as those assets are managed by the robo-advisor. And the robo-advisor charges 0.5% management fee. So the money, in that case, we would move away from a company that's in the stock market. In this case, we would keep it in the stock market. So that money is going to go up, it's going to go down, but at least our management fee has been significantly reduced. So when the market goes up, well, I always say to a client, if you're at BMO mutual funds, and if you move it over to the robo-advisor, if the market goes up, you're going to make more money at the robo-advisor because there's less management fee. If your money goes down, is going to go down less than it would at BMO because your management fees are less. So it's just really, again, education, explaining to the client what goes on with their money, who's getting paid, how does that affect them, and is there a better way? And 99% of the time there is.
Okay, I think I just would like to mention a little bit about my role as a dealing representative.
Yes, yeah, please do.
So
Yeah.
first of all, Gerry, after you talk to people and you come up with some ideas and suggestions, and if the people want to invest in a private equity,
Yeah.
or MIC or real estate investment
Yeah.
trust or something like that, and if it would go through me, I'm licensed through Huxton Black. Huxton Black is an investment firm based out of Hamilton. They're an exempt market dealer, as Gerry's was referring. So this is a license that I obtained. It's under the Ontario Securities Commission. I will tell you that there are a lot of regulations in this in that industry. And the course that I took was, I would say, probably harder than the mortgage broker course to pass. Okay, just as an FYI. Anything that I arrange for you has been vetted by our investment firm also, Huxton Black. So you've got a couple of pair of eyes that are looking at it. And also part of my role is to go through some basic things with you to ensure that the investment that we're planning is indeed suitable for you. That, you know, we have to take a form and determine whether you're an eligible investor or an accredited investor. There, you have to qualify. You can believe it. The industry is that strict. You have to qualify to purchase. And we have to ask you about your income and your net worth to make sure that whatever is being recommended that you want to buy is indeed suitable for you, the level of risk, and so on and so forth. So that is all part of my role. We're streamlined very nicely today with DocuSign and all those things. Amazing what we've been able to do remotely. And you know, people get regular statements from these different kinds of investments, so they know what's going on with their money. And we help keep an eye on things for you as well. And of course, I'll just put in a little commercial for myself while I've got the floor. Of course, here at Rock Your Mortgage, we arrange mortgages for first-time buyers, for move-up buyers, for people who are looking to buy multiple properties. Sometimes they are not given the assistance they need at the bank. People who may have a credit issue. We work with retirees. We work with builders. We work with flippers. I had the pleasure of arranging a mortgage on one of Gerry's recent flips for the purchase and for some of the construction. And that's what I do on the mortgage side as well. And it's, you know, always a pleasure working with Gerry, and he's been a great guy to work with. And Gerry and I have grown a lot and come a long way together here running these regular seminars. And it's so great that you're all here. I'm just going to do a time check. Well, it's now 10:28, so I mean, I don't have a problem hanging around further if anybody wants to hang around and chat and ask additional questions. But I should just say I did put Gerry's phone number again there, and the link to his website. Gerry, you should probably in the future get one of I don't know if you have one of those Calendly links so people could go right to your appointment.
Yeah,
but if you want to
would.
book a session with Gerry, they should just give you a call, right, Gerry?
Yeah, you can go to my website or there's my phone number. I put it in the chat line, but you're right. I should get a better link. If I could just maybe expand on what you just said, David, and I appreciate you explaining your role and what you do as what we call licensed dealing rep, and how that works within my model. Again, Canadian Investment Services, I choose to operate this company without an investment license. Okay, what does that mean to you? It means I can tell you about the products. I can give you education, information. I can help you source products that you want. I'm not tied to anybody or anything. So we usually end up sourcing a product that you want to, that you are interested in. Without a license, with not having an investment license, I cannot process an order. I cannot do the paperwork for the order. Okay, so I can tell you all about real estate income trusts. I can tell you the good, the bad. I can educate you about it, give you information. I can talk to you about different types of real estate investment trust companies. And when you say, hey, Gerry, I like that company, I cannot process an order. I call my good friend David. David, I have a client here that you have to go through the process. David's role is to determine suitability, to meet with the client, make sure all the rules and regulations that are established by the Ontario Securities Commissions and everybody else that governs that industry. So we need David there to make sure all those rules and regulations are complied with and to literally process the order. And that's, from my point of view, that's, I like that model. So I can be very unbiased. I'm not tied to anybody or anything, and I can really put the best interest of the client first. So thank you for explaining your role, and that's really how it works within my business model. Yeah, we never even touched on Prex. Oh my God.
We didn't. Okay. Well, give us a short prep windup, and then we're going to stop the recording, officially stop the thing, and people can chat if they want, or just give us a call to talk further.
Personal real estate corporations introduced to the real estate industry in October of last year, 2020. By far the best thing that has ever happened to a real estate agent. Okay. Probably every real estate agent can benefit from a prep. Okay. And what it really means, and I've done so many, I've been in the tax business for 40 years. I've done so many real estate agents in the past, and the ones that are successful and even medium successful, we've had to put big net income numbers onto a personal tax return and pay all kinds of personal taxes. Now with these precs, we can flow all your real estate commission income into a corporation, okay, that pays 12.5% tax compared to what you pay personally. You personally, people are in 4 different tax brackets: 20%, 30%, 40%, and 50%, depending on your income levels. So you're at a much higher level. And if you're making any type of income, you're going to be in a 30 or 40 or even 50% tax bracket. Now that we have Prex, we can channel that income into a personal real estate corp. We can pay the 12.5%, which is much less than you're paying. We have all kinds of options on how to get that money out of your company. We can now use dividends. Dividends are a great thing. We can literally pull out about $40,000 of dividends from your PREC and not pay any personal tax due to the whole dividend tax credit mechanism, which I don't want to do a deep dive into. All I'm saying is there's so many tax advantages. And then we see the real estate agents, the real key is if you earn more money than you need to live personally. Okay, so if you gross 200,000 and 60,000 of expenses and you got $140,000 of net income, we're going to put that through the personal real estate corp, and we're going to figure out what you need to take out personally. Let's say you need $4,000 a month, $48,000. So the difference, we've got over $100,000 that we can build up in that corporation. We've saved you a ton of taxes. Okay, now you got a corporation, a PREC with money in it. What are you going to do with it? Well, you can do anything with it. You can buy real estate income trust. You can do private mortgage lending. You can do whatever investment vehicle you want to do. I'm somebody, I do not like RSPs. That's a whole other 1-hour session. Okay, I'm not a fan of RSPs at all. I think your personal real estate corp is a much better vehicle to save for your future. Okay, we're building up what we call 87.5 dollars. And what I mean by that is we earn $1, we pay 12.5% tax, we retain 87.5 dollars. We can't do that personally because our minimum tax rate is even 20%. So we have a great opportunity to build up all this money in your corporation and use it as an RSP. There's so many benefits for estate planning. Again, that's a whole other session.
Gerry,
yeah.
What question has come up from Michelle? What's the cost to incorporate a PREC? Do you create a PREC for the realtors, or does a lawyer do it?
So anybody can incorporate. Okay, I can incorporate you. A lawyer can incorporate you. You can incorporate yourself. maybe not advisable, but we certainly, I provide incorporation services for people, lawyers do. So yeah, it's not, it's not only lawyers that are required to set up a corporation. So the kind of rule of thumb I always use is if there are more than one person, if you're incorporating yourself, I can help you. I can incorporate you. If there's two people, if it's two partners, okay, two spouses, no problem, I can incorporate you. If you got an outside partner that you're setting up a corporation with, then I say go to a lawyer because you need a shareholders agreement. There's all kinds of legal stuff you need. With that said, in order for your corporation, if you're going to set up a PREC, Personal Real Estate Corp, one of the regulations established by the real estate industry is you, the licensed real estate agent, must own 100% of the common shares, the common voting shares. So you must be 100% owner of your PREC in order for it to qualify for your brokerage to channel your commission income through. Now, many people say, how can I income split with my spouse or whatever? Yes, we can put the spouse on as a non-voting shareholder, no problem. We just need to have you as the voting shareholder of the corporation. Somebody says how much to incorporate. I charge $1,300 to incorporate, of which probably $600 or $700 of that is costs out of pocket. Okay, so I have to pay the Ministry of Finance fees. I have to pay the whole bunch of fees. So my fee is about $500, and then on top of that, you're going to pay $700 of fees. So if you pay me $1,300, I'm going to pay $700 of those fees for you. I give you a summary of everything I paid out, and then my fee to incorporate is about $500. So.
So you've been very busy with these.
Oh my God, it's been I've been very busy and very, very busy. But the really exciting thing is not only just being able to channel your income into a PREC, but the things that you could do within a PREC to save money, to part of an estate planning tool. Okay, I'm a estate planning. Here's another 1 hour session that we should do one day, because what happens is people are not properly doing their estate planning. Okay, estate planning is not today, let's do something that's going to happen when I die. Estate planning is a process, and once again, I use my financial planning tool that I give away for free. We show you your financial life, and all of a sudden, we build assets our whole life. Okay, all of us want to build assets. We make money, we buy assets. And we do that. Obviously, this is what drives us. It's what we do. We go to work, we make money, we want to learn about investments, and we want to make money. And we do that in order to, have an asset base for now and later on in life. But as you build up that asset base, inside there, you have a ticking tax time bomb. Okay, and it's going to carry with you through your whole life. And we build assets in one of three ways. We build assets